Okay, good. And my recollection is that we had agreed that we would finish up a little bit of that chapter. Was it chapter 7 or chapter 8? Where am I? We had the earnings per share stuff. Was that chapter 8, right? Or chapter 7?
Chapter 7.
Chapter 7. Okay, thank you. I had so many chapters open today, I started to forget which ones I had open. So let me go back to open my chapter 7. Okay, good. And it took us back to where I recalled we still have to look. So, and the reason I had so many chapters opened is because we are going to be finishing up chapter 8. We're going to start chapter 9. And then, excuse me, we're going to finish chapter 7. We're going to go through earnings per share for chapter 7. Statement of cash flows I'm going to ask you to look at, or you probably already looked at that on your own. Then we'll move into chapter 8. We're going to jump to the discussion of governmental accounting. And then I have chapter 9 open because there are some things in chapter 9 that I want to show you now, even though we're not going to get to that material here today. Okay, so I'll wait till the discussion of what we're going to do in chapter 8 until we get to it. Let's finish up chapter 7 here first. Okay, and so I'm going to go ahead and put myself in full screen, and I'm going to try to put my computer in tablet mode without everything going to hell. My hand basket. A hard time because I put the machine into tablet mode. It decides that that's correct. Okay, so let's see. Okay, you can hear me, right?
Yes.
Yes, clear.
Now we'll see. We may have to. No, okay, I guess that's staying open. I may have to open some other things that I had ready to go, but at least that thing that we're working on right now is going to be okay. So what we're going to look at is earnings per share. And, this stuff really. Okay, so what we're going to look at here is the earning. We're going to have a problem today if this isn't going to work. Okay. I'll be back. Okay, let's go ahead and try this again. Okay, and take 3 on this. We're going to talk about earnings per share calculations. And we're going to start talking about simple calculations, simple capital structure earnings per share. I think most of you will find that this material is pretty straightforward, but there is enough coverage on the exam. There's a few nuances that I think it's worthwhile spending our time to capture, maybe the 5, maybe even 10 points that might be covered in earnings per share calculations. Okay, so our primary earnings per share is calculated, and you should flashcard, as income available to common shareholders divided by the weighted average common shares outstanding. And we're going to talk a little bit about how to calculate the weighted average number of shares outstanding. Note that there is a section there in chapter 2 where we talk about all sorts of different ratio, and you do need to know all those ratio, and included in there is a discussion of earnings per share, but at least this basic formula, but not so much the details of it. And so I want to walk through that here with you. Now, income available to common shareholders, okay? And that's going to be net income minus any preferred, minus any preferred stock dividends. Okay, and then you'd have that weighted average number of shares. Now you can see that on the next page, they go ahead and they start to define a little bit better income available to common shareholders. Okay, and if you take a look at that, you should flashcard this. Income available to common shareholders is determined by deducting from the line item income from continuing operations, net income, and then dividends declared in the period on non-cumulative preferred stock, regardless of whether they have been paid, and dividends accumulated in the period on cumulative preferred stock, regardless of whether they have been declared. Okay, so if we have dividends, they don't have to be paid. That's the main thing. If it is non-cumulative, then it has to be declared in order to be considered a preferred dividend to be subtracted from the income available to the common shareholders. If it is cumulative, it doesn't matter if it has been declared. And when we look at that, we look at it year by year. So problems will talk about, amounts being declared or amounts accumulating on cumulative in year 1, and then amounts being paid in year 2. When they actually get paid does not matter. It is when they are what? If it's non-cumulative, it's when they're declared. If it's cumulative, it's whether they have been declared or not. And we're going to get some practice with that here when we start to look at some of the questions. Now, when you come over to the weighted average number of common shares outstanding, okay? And they give us some things that we're going to need to flashcard here. And again, you can kind of start to see why I'm going through this with you. It does get a little nuanced. It's not terribly difficult, but if you don't put the right flashcards and the right things, it could start to, snowball and you feel like a little overwhelming, okay? So when we're trying to calculate that, we will see that we will start with the shares at the beginning of the period, shares sold during the period on a time-weighted basis. For example, if the stock was issued, say, July 1st, okay, the additional shares were sold on July 1st, then we would weight those number of shares by half the year. Okay, if it was issued on December 1st, then those shares would only have been considered outstanding for 1/12 of the year. Okay, minus shares reacquired during the period. And guys, don't forget, Don't sleep on your treasury stock calculations. I had you look at that on your own. That's material that was earlier in this chapter, but you need to understand the cost method, which is used by 95% of the companies, and the par value method, which is used by 5% of the companies. I often get annoyed with the ICPA, and if they seem to be in love with methods that aren't used very much, they still like to ask questions about that. Meanwhile, they're trying to move us all ahead into, the new exam and getting more in line with common current, trends. Meanwhile, they continue to ask us about things that are almost obsolete. But anyway, I can't control them. They control us, quite frankly. And so you'd have to know both the par value and the treasury method. And then you come down and stock dividends and stock splits, which are retroactively adjusted, meaning that if the stock split took place in the middle of the year, you would act as though that stock split or that stock dividend had happened at the beginning of the year. And then that's the same for reverse stock splits, although, I don't see that very much in questions. The sum of all those adds and subtracts then would be the product of all those adds and subtracts would be the weighted average number of shares outstanding. So you can see, guys, that gets a little bit, a little bit cumbersome. So we're going to practice with the example here. Before we do, though, again, stocks, dividends, and stock splits must be treated as though they occurred at the beginning of the period. Okay, so make sure you have noted that point on that flashcard. That's what they mean by retroactively adjusted. Okay, for both of those, I guess, reverse stock splits, although I don't see those much in questions. Okay, good. Now let's come over and let's take a look at this example. And this is a pretty good example, although I'm going to change things up a little bit. You can see the fact pattern. They had the shares outstanding at the beginning of the period. Okay, so we start with those shares outstanding at the beginning of the period, but then they tell us that there was what? A 2-for-1 stock split, which has to be retroactively adjusted. Now, the way I would do this is I would say, well, that means that I actually started the year with what? 2 million shares. Since there was 1 million at the beginning and they did a 2-for-1 stock split, that means there was 2 million shares, and then I wouldn't do this multiplication over here. I just like to look at it that way. If you like to look at it the way they're doing it, fine. There's nothing wrong with that, but I prefer to just say, okay, if they did a 2-for-1 stock split, happen, after about a quarter of the year, but I'm going to assume that was something that was at the beginning of the period, okay? And things sat like that. They did it at July, March 31st, but then on what? On April 1st, they sold some more shares. They sold what? They sold 3,000 shares. So what happens when they sold, not 3,000, but 3 million? So when we go from 2 million and we issue an additional 3 million shares, that's now 5 million. And those sat there and nothing else was done for all of April, all of May, all of June, July, August, September, October, November. That's 8 months. Make sure you're counting your months correctly. If you need to count them on your fingers the way I just did, go ahead. Okay, just make sure you're careful in how you calculate your months. And then on December 1st, they went ahead and bought some treasury shares. So what happens? We go ahead and we multiply that 5 million times the 8 months divided by 12 that it was outstanding, come out with that product. Okay, and then we had purchased 500,000 shares, so now we're down to 4,500, and we ended the year like that from December 1st to the end of the year, so that was 112. Do the proper weighting there, and you have your weighted average shares. Question? Okay, good. So let's go ahead then, leveraging off of that information, and let's look at our first multiple choice question of the evening here. Are you seeing the poll, guys?
Yes.
Yes.
Good, thank you. Okay, we're coming up on 2 minutes now, so I'm going to go ahead for sake of time and end the poll. And let's take a look at this question now. And looks like a good 70% of us got it right. A couple of folks wanted to pick A and B here, but let's go ahead and see how we got to the correct answer here, which is D. Okay. And so let me set this up. My mouse is playing hide and seek with me as it usually does, but let's just take a look. And we tell us on December 1st of the current year, Clay Company declared and issued a 6% stock dividend on its 100,000 common shares, outstanding common shares. There were no other common stock activity during the year. What number of shares should Clay use in determining its basic earnings per share? So we know that we have to have at least 100,000 in the answer because nothing's under 100,000. But then what? We had that stock dividend, and it was a 6% stock dividend, meaning that you take that 100,000 times 0.06, meaning that they would what? They would issue an additional 6,000 shares. Now, even though they don't get around to doing that until what? December 1st, because we treat stock splits as though they happen at the beginning of the year, we're not going to do any of that, waiting for the number of years for those. Those were retroactively adjusted. And so the correct answer here is the 106,000. Question. Okay, good. Let's go ahead and let's take a look at question 2. Okay, guys, we're coming up on about 3 minutes now. So I'm going to go ahead and end the poll because, of course, even though we may give you a little more time here in class. You should be averaging about 2 minutes. I would think a question like this on the exam, you might take a little more than 2 minutes, maybe 3 minutes, but no more than 3 on any one question. So I want to stop there and end the poll and take a look. And okay, you know, we're getting close to 70% on this one. But not, you know, not at 70%. I'd like at least that here in class as we go through this stuff. So let's spend a little time understanding some of the nuances of this, and you can see why I want to spend some time talking with you through some of these things, because they can get a little confusing. Okay, so what happens? We're sitting here and we have this preferred stock, and they tell us it is what? Cumulative preferred dividends. Okay, now they tell us that UTE reported net income of $500,000 for the year. Now, when I think about how I have to calculate this, I know right out that I'm going to take what? The income available to the common shareholders, but I'm going to have to adjust that for preferred dividends. And the rules were what? For the preferred dividends, if they're cumulative, I have to subtract them as preferred dividends, whether declared or not, whether paid or not. In fact, paid is completely irrelevant when it comes to the preferred dividends, period. Okay. It doesn't matter if they're declared, if it's cumulative. So I take a look and they tell me that what the preferred dividends during year one, for year one, they paid no dividends in year one and paid $16,000 in preferred dividends during year two. And I don't care. I don't care when they paid them. I don't care what they declared. It doesn't matter. The dividends on the cumulative accrue regardless. Okay, so that's all distractor information. So when we want to get the basic earnings per share, and they're asking me here now year two, well, just think about it. In year one, they would have gone ahead and they would have had to consider the dividend on the 4%, 250,000, and you take that 250,000 times 0.04, that gives you 10,000. So if I had been calculating the, basic earnings per share for year one, I would have subtracted that 10,000 from the year one income. Year two, okay, we have the 10,000 again, and we subtract that in calculating the basic earnings per share, whether they are declared or not, whether they're paid or not, when they are cumulative on preferred. So we go ahead and subtract that 10,000, which in that case was relevant to year two. Then it give me the year one income. So I couldn't do year one here if I wanted to. And so that would give me what? 490,000. And this question, you'll see some that may actually ask you to also calculate the denominator. So you'd have to calculate the weighted average shares outstanding as well on a question. This one just focused on the numerator here, and they gave us this 200 shares issued and outstanding. So we take that 200,000 shares, right? And that's how we got to this 245, which was the correct answer. Question. Okay, so you're going to need to practice with those guys, those questions. I think you can see that they can get a little tricky. So you have to read carefully. You have to kind of put things down as you understand them, and you'll be in good shape to answer those. But it does take, this is not so much a aerobic exercise. This is somewhat of a weightlifting exercise. You got to sort of practice with getting through the reps on those to be able to do a good job with them. Okay, good. Now we come down and we start to talk about a complex capital structure. Okay, now don't be frightened by the word complex. Okay, all that means is there's a potential that we could have some instruments that could make the earnings per share less. We call that a diluted earnings per share, less than the basic. And if it does create a situation where convertible bonds are converted to common stock, or preferred stock is converted to common stock, or we have potential employee stock options that are going on. We're going to have to pretend, this is one of the few times in accounting we get to pretend, as though that had actually occurred during the year, and how would that affect earnings per share? And we only report that different number, how it would affect earnings per share, if it causes the diluted earnings per share. Well, that's redundant. If it creates a diluted earnings per share, which means that the earnings per share goes down. If the earnings per share goes up as a result of the conversion, we don't report that. Okay, so we're going very conservative with this stuff. When I say we, I mean the accounting standards. Okay, so an entity has a complex structure. When it has securities, it can potentially be converted to common stock, and therefore would reduce earnings per share of common stock. Okay, now they tell us that under that circumstance, both basic and diluted earnings per share must be presented. And then they start to talk to us about the nature, which I sort of rattled off a little bit here earlier, of potentially dilutive instruments, which include convertible securities, for example, bonds that could be converted into common stock, preferred shares that can be converted to common stock, warrants and options, okay, contracts, contingent shares, etc. Okay. Now you come over, and we're going to talk about some of these, starting with what happens when we have dilution from options and warrants. And they give us the diluted earnings per share formula here, guys, which you can go ahead and flashcard that. The weighted average number of shares outstanding, assume all dilutive securities are converted to common stock. That goes into the denominator, and then the numerator would take the income available to common shareholders, but it would add interest on the dilutive securities. And here we're talking about debt securities, since we're talking about the interest. Okay, so go ahead and flashcard that, but let's just go ahead and let's take a look at what happens with the if converted method from convertible bonds. Okay, so we're going to start actually with the convertible bonds. So let me go over, because for some strange reason they changed the order of this in this text for some reason. I don't know why, but let's just go ahead and let's take a look at that. And the if converted method assumes that all securities were converted to common stock at the beginning of the period, or at the time of issue if later, meaning when the bonds were actually issued. So the bonds were issued last year, we assume the conversion happened at the beginning of the year. But if the bonds were issued this year in, say, June, then we would have to only deal with that for half the year, July 1st, let's say. We don't have to deal with that for half the year, because there's no way they could have been converted at the beginning of the year, because they weren't issued yet. The securities weren't issued yet. Okay, so if it is convertible bonds, let's go ahead and let's flashcard the steps. Okay, sometimes it's helpful to have the steps so that, remember, guys, as you come to the days before your exam, the last 2 or 3 days before your exam, and I see a lot of stuff on Facebook. I never respond to any of it, but I'm sitting there, almost shaking sometimes, reading some of the things that I see as advice. And I see, amateur advice givers on the Facebook, the Becker Facebook FAR page, whatever they call that group, whatever. And they say, the couple of days before your exam, you should just go walk in the park and feed the squirrels and take your mind. That's nonsense. That is nonsense. Okay. If you go to a basketball game, do you see Stephen Curry's feeding squirrels just before the game? No, he's sitting there. He's not smoking cigarettes and drinking before the game. He's sitting there and he's practicing. I saw the game the other day, and he had somebody throwing the ball at him in close range over and over again, because he knows that that's something that he wants to make sure that is sharp come the day, or that evening when the game starts, right? Well, you're going to be that same way. And so the way you do that is you should be drilling with your flashcards over and over again the last 3 to 4 days before the exam. So I don't believe in getting all stressed out and working a bunch of homework questions. I get that. But the last couple, 3 days before the exam, you need to be sitting there and going through those flashcards over and over and over again, staying sharp with the material and paying particular attention to things where you think maybe you want to remember what some key steps are. So that's why I asked you to, flashcard these steps here, okay? So let's look at the numerator in our calculation of our diluted earnings per share. Add to the numerator income available to common shareholders, which means you would be putting back interest expense net of tax, because if you didn't have the bonds, you wouldn't have to pay that interest. And when you pay interest, what happens? That shields a certain amount of money from income tax. So you have to calculate the benefit net of tax, okay? Then to the denominator, you should add the weighted average number of shares associated with the assumed conversion. And if the convertible bonds were issued during the period, assume the stock was issued at the date for the weighted average. In other words, the bonds were issued in the middle of the year. Okay, I don't know that you need this other flashcard, but you could probably turn this whole discussion into one big flashcard. I don't know that you need two separate flashcards on that. Okay, good. So notice we do, as I said, we get to pretend here. So the actual was that we had income of 100 before the bond interest, but we had bond interest, so our income was 80. We had to pay what? $32 of tax on that, assuming the tax rate was 40%. So our income would have been, well, our income was 48. But when we pretend that we had actually converted those, we take away the bond interest, but we lose that what? We lose that tax shield on that bond interest. And so what we'd have to pay in tax would be what? Would be $40. So our net income would have been 60, and that would be the numerator. And then you would divide that by the weighted average number of shares. Okay. Now, you only report that if it is anti-dilutive. In other words, if it causes the earnings per share, you would report that lower earnings per share if it caused the earnings per share to go down below the basic, sometimes called the primary earnings per share. So let's go ahead and let's look at this. And this is nice.
Can I ask a question? Yeah. Why in the pretend you're not including the bond interest expense?
Because if the bonds were converted to stock, they wouldn't have been outstanding, so we wouldn't have incurred that interest, right?
For the whole year, we're assuming it's the whole year, right?
Yeah, and this, whatever the interest expense would be, okay, they didn't tell us here, frankly, whether it was the whole year or part of the year, whatever the interest expense was on that. They told us it was what, 20? I don't know if that constitutes all of the year or part of the year. It would depend on when the bonds were issued, right?
Yeah. Okay.
Okay, good. So let's go ahead but that's a good point, Pauline, that the interest expense would have only been incurred for the period the bonds were outstanding. So again, if the bonds got issued July 1st, just making a number up, say they were 6% bonds, is $1 million. $1 million times 6%. Assuming that they were issued at face, whatever the outstanding amount of the bond was for the period, right? If they were issued at discount, it'd be less than face, the premium more than face, like we did in chapter 5, times the interest rate, 6%, whatever it was. And if it was half the year, that'd be times 1/2 to calculate that interest expense. And we would also have to weight the conversion for half the year, right? In the denominator. Yeah. Good. Okay, good. And I think you'll probably see some questions like that in the homework. And again, I do keep saying this. This is kind of why I'm going over this with you. It's not conceptually that difficult with some practice. you'll get good at it. That's why I'm kind of using that silly weightlifting analogy, and that it's one of those things that you got to kind of, I see what I need to do here. But this is also why I'm going through this with you. Okay. All right. So anti-dilution. So use the results of each conversion only if it results in dilution, reduces the earning per share. Not include the results of assumed conversion if it is anti-dilutive. In other words, increases the earnings per share. Okay. And notice that in determining whether potential common shares are dilutive or anti-dilutive, each issue will be considered separately in sequence from the most to the least dilutive, with options and warrants generally included first. And we'll talk about options and warrants here in a while. And so flashcard that. Only report something if it is dilutive, and you calculate them separately. So let's look at this example. I think I'm going to, kind of drive this point home here in a couple seconds. Okay, so what happens? We're sitting here, and they tell us Company X has 100,000 shares of common stock and 500,000 in 6% bonds convertible into 10 shares for each $1,000 bond, and net income for the year is 100,000. Now, to me, one of the things I always struggle with on these questions for some reason is, well, how many bonds are we talking about? Well, you take the 500,000 of the bonds that they have, okay, and they say it's what, $1,000 bond. So you divide that by the $1,000 bond. That means we have what? 500 bonds. Okay, and maybe that's easy for you, but I always kind of sit there and stare at questions and struggle with that a little bit. Okay, so then we have what? 500 bonds, and then we multiply that. They say could be converted into 10 shares. So 500 bonds times 10 shares means that the total common shares outstanding were 105,000, and these bonds were outstanding at the beginning of the year. So we don't have to, do any conversion there, okay, any weighting there. So that's 105,000. Then we go ahead and we say, well, the net income they told us from the problem was $100,000. And if they had converted those bonds, they would have eliminated the interest expense for the year net of tax. So since the tax rate is 34%, 1 minus 34% gives us the the net of tax interest that is saved here. And so we go ahead and we multiply the 500,000 times 6% times 1 minus the tax rate. What's that? 66%. And that gives me what? 19,800 net of tax interest they saved. They would have saved had they converted the bonds. Okay, so that gives us what? Total net income of 119,800. We divide that by what? These 105,000 shares means that they're finding that if the bonds had been converted to stock, the earning per share would have been $1.14. But the basic earnings per share, what actually happened was the 100,000 net income divided by what? The 100,000 shares of common stock. So it was what? $1. So since that bond conversion is anti-dilutive, we will do what? We will not report the anti-dilutive. And so it's kind of like you go through all that trouble to figure out what not to report. Okay, we would not report that. If it had been less than $1, then we would report it. And don't net dilutions. They may give you two potentially dilutive securities, maybe a bond and preferred stock. One will be dilutive, one will be anti-dilutive. Don't net, together they turn out to be anti-dilutive. Don't do that. You only report the effect of the dilution if it is dilutive. Okay, don't net it against ones that are anti-dilutive. Okay.
Up above, it says each issue will be considered separately in sequence from the most to least dilutive. What does that mean in this situation?
In this situation, it means nothing.
Right, but if you had another one, like how would you put it most to least dilutive? What are they asking for?
I don't know what that means. All I
Okay.
know is if it brings if anything is results in the calculation results in an earnings per share that is higher than the basic earnings per share, throw it in the garbage.
Okay, sounds good.
Don't consider it yet. Okay, I'm not sure what that other thing means. You know, sometimes I feel like when Becker's writing the book, someone's drinking, you know, too much caffeine and they see something written somewhere in another book and they put it in there and they don't even know what it means. But anyway, don't worry about it. Okay, just do it the way I said. If it causes the earnings per share to go up, throw it away. You're not going to report it. If it causes it to go down, yes, that you would report. If you have a second one that causes it to go down, that'll cause it to go down even less. That's how you report it. But if you have one that caused it to go up, or one's causing it to go down, throw the one that caused it to go up away and just look at the effect of the one that caused it to go down. Okay. Okay, good. Convertible preferred stock. Okay. And we say for the convertible preferred stock, pretend that it was converted into common stock, okay, and adjust the numerator as preferred stocks dividends do not affect net income, okay, so we will simply go ahead and pick up whatever the net income was, okay. Sometimes they'll give you what the preferred dividends were and your instinct is going to be to add that back to net income. No, net income was net income. And when we're trying to calculate the basic earnings per share, yeah, we subtract the preferred dividend. But if we're trying to say, well, the preferred was converted into common shares, then we just pick up whatever the net income was, right? We don't have to make any adjustment to the net income, and then add to the denominator the number of shares associated with the assumed conversion. Okay, so let's look at this example. We have outstanding 100,000 shares of common stock, 10,000 shares of convertible preferred stock, and they can be converted into 5 shares of common stock. So let's just look at that. 10,000 times 5 is 50,000. No dollar sign here, guys. I shouldn't have put that dollar sign. That's the number of shares. Okay, so there's no dollar sign there. Okay, and that gives me what? That gives me 105,000 is the number of shares, and then my net income, they told me was 100,000. And notice they give me what? The dividends declared on the preferred stock of 20,000. I don't care. Okay, I do not care. I just simply want to take what? The 100,000 of net income, right? Because if you get rid of those common shares, then there is, you get rid of those preferred shares, I should say, and convert them into common. There is no preferred dividend. You divide that by the 150,000 shares now, and that gives me what? That gives me 0.67. And then you look at, well, what was the basic earnings per share? The basic, yeah, then I would have taken the preferred dividends, and I probably shouldn't have crossed it out because you need to consider it to see if it is, if the conversion to preferred stock was dilutive or not. And sure enough, it was, and so it would be reported. Okay. Okay, good. Options and warrants. Okay, for some reason they decided that dilution from options and warrants should go last now. I used to like it where they had it before, but that's okay. They can, it's their book, they can change the order if they want. Okay, options and warrants. Okay, options and warrants give the holder the right to purchase the stock of a company at a specific price over a specific period of time. Upon exercising the option or warrant, the owner will own shares of stock. Okay. Now, the owner would only exercise their right if the strike price or exercise price is below value. So doing so would allow the holder to purchase the stock for less than it would cost in the market. Use the following steps to determine if the warrants are what the effect they would have on the earnings per share if they were exercised. And you're only going to report it, of course, if it is dilutive, right? So compare the strike, the exercise price, to the average market price on the underlying stock. If the strike, the exercise price, is above or equal to the average market price, no adjustment to diluted earnings per share are necessary. Two reasons. One, why would somebody do that? Why would somebody exercise an option price that is more than the market price? If they want the stock that bad, they would just go buy it. The other reason, okay, is that we're going to use the treasury stock method, which is going to assume that the additional money that comes in when folks exercise the option, the warrant, whatever, there'll be additional money coming in, and we're going to take that money and we're going to go out in the market and reacquire some of those shares. Well, if we got enough money coming in to reacquire all the shares and more, that would automatically be anti-dilutive, and therefore we wouldn't report it. And so we would only go for this calculation if the exercise price is less than the average market price. And be careful, guys, it is the average market price. You'll have to pick that question up, because now as that additional money comes in, people will exercise that and additional money comes in, but we won't have enough money coming in to do what? To buy back all of the shares, and therefore that will be diluted as we pretend that those options were exercised. Okay, so let's look at this example. Okay, and we have what? We have 1,000 options to purchase 1,000 shares of common stock. Okay, the exercise price is $15 per share. The average market price is what? $20 per share. And the year-end market price is $25. I don't care what the year-end price was. I care what the average was. Okay, now what happens? If I sat there and I looked at this, I'd say, well, okay, this is going to be diluted. Okay, and let's go ahead and see why we think it's going to be diluted. And so we would sit here and say, well, look, the additional shares are going to be equal to what? The additional shares outstanding. Okay, the additional shares outstanding. How do I want to do this? Never mind, it's additional shares. Additional shares outstanding, that'll be outstanding after we do this, okay, are going to be equal to the new number of shares. I'm not doing a very good job of writing this. Write it over here. I need more room. The additional shares are going to be equal to the new number of shares minus shares repurchased. Now, how do we calculate the number of shares repurchased? Well, we would take the number of shares times the exercise price, calling that the X price here, exercise price, and divide that by what? By the average market price. Okay, now let's just go ahead and let's do that for this fact pattern. Okay, but I think it's probably worth flashcarding what I just wrote there. But let's just look at this, and it's what? it's 1,000 options to purchase 1,000 common shares. Okay, so that means potentially there'd be 1,000 more shares. Okay, that's that additional share number. Okay, maybe I guess I can't squeeze it in here. Okay, that'd be that additional share number. That's the 1,000. And then I'm going to go ahead and subtract from that. And in this particular example now, we have what? We have the $1,000 that's going to come in. I mean, the 1,000 shares that's going to come in. 1,000 shares are going to have to purchase, and they're going to have to give us what? $15 per share. So that means 1,000 times 15 is $15,000. Okay, because they're going to have to turn in the options, whatever, and give us $15. And then what? We're going to take that $15,000 and we're going to buy the stock, and we're going to buy the stock using what? Using the average market price of $20, meaning that what? We could repurchase what? We could repurchase an additional, and if you do the math on that, I think it says we could repurchase another 750 shares. So since we had to issue an additional 1,000, but we were able to buy back what? 750, and this is all pretend. That means we would have had to issue an additional 250 shares. And of course, that's automatically going to be anti-dilutive because the net income isn't going to change. What has changed is the denominator as the shares have gone up by 250. Question? Okay, good. Now, dilution from contracts that may be settled in cash or in stock. If the contract should be settled in either cash or stock at the election of either the entity or the holder, presume settlement of the shares, calculating diluted earnings per share. Okay. Flashcard that. And then if it is dilution from contingent shares, okay, and contingent shares, as the word contingent indicates, is what? Something that may or may not happen, right? But contingent shares that are dilutive are also included in the calculation of basic earnings per share if at the date all conditions for issuance are met, even if they hadn't actually issued them. And an entity must use the period end share price to determine the denominator for the diluted earnings per share calculation. Flashcard that. And then continue on to the next page. And if necessary, if the necessary conditions have been satisfied by the end of the period, those shares are included in the basic earnings per share at the beginning of the period in which the conditions were satisfied. Okay, so even if they hadn't gotten around to issuing the shares, the assumption is, hey, they're going to very soon, and so calculate in that and include that in the basic earnings per share, even if they hadn't actually issued the shares yet. Disclosure, okay, and cash flow per share should not be reported. Okay, cash flow per share should not be reported. Flashcard that. In addition, reporting the basic earnings per share and diluted earnings per share for both income and continuing operations and net income and the effects of discontinued operations, the following disclosures are to be met. And guys, just go ahead and flashcard those. At some point, I'm just reading off a bunch of disclosure requirements. Do flashcard what needs to be disclosed, or find in your Becker flashcards. where they're saying the disclosure requirements are on some of that. But definitely flashcard cash flow per share should not be reported because the exam loves to try to trick you on that. Okay, good. Let's go ahead and let's take a look at a couple of questions. Okay, looks like everyone's had a chance to try this one in under 2 minutes with a perfect result. Very good, guys. Notice that what? We only include the one that was dilutive. So you had what? The 75 cent was dilutive. So we subtracted it from the 15 to get the correct answer C here. You do not what? Net the two where the other one was anti-dilutive. You throw it away and you just report the effect of the diluted one. Good. Okay, let's go ahead then, if we're happy with that one, which I don't see why we wouldn't be. And let's take a look at this next one. Okay, guys, we're coming up on 3 minutes, so I should wrap this one up. Okay, I'm not sure why we're still waiting for folks on the 3-minute mark here, because this question is pretty straightforward. But let's go ahead and let's end the poll. Okay, and most of us got this right. Okay, we got a couple folks who might be question, but let's go through this. And when you look, they're asking, what we should report as the diluted earnings per share here. Okay, now, what amount is Ian's diluted earnings per share for the year? So when you look at this, you're like, well, look, I guess they're asking me what would happen if these shares got converted, because this is the only conversion issue that they're talking about in here. And maybe what threw some of you off, that was maybe taking a little longer, as I said, ignore the year-end market price. But if they don't give me they don't give me anything but the year-end market price, then I have to go by that. I don't know if the average market price was maybe a little higher, but here they just give me the year end. And since the year end is below the exercise price, then I'm going to ignore that, because that's going to be anti-dilutive. First of all, no one's going to exercise that option. And why would somebody go and pay $30 per share at the option price when they could go into the open market and get it for 25, number one. But then even if somebody was, sniffing glue for some, had painted their house and got too many fumes in their head and decided to do that, they'd give us enough money to do what? To buy back all the options and then some, buy back all the additional shares that were issued by the option and then some. And that would, by definition, be anti-dilutive, because it would reduce the denominator. There's no numerator effect. There's no net income effect. It would reduce the denominator to a level less than it was for the basic, and that would increase the earnings per share, and we don't report that, right? So that means that we have to take that 125,000 and then this becomes a weighted average shares calculation, a very easy one, by the way, which is what? The 15,000 times what? The reason I say it's easy is there's no stock splits or anything that we have to deal with. Then what? From April 1st to May 31st, which is another quarter of the year, it went to 12,500. We don't have any stock dividends or stock splits that we have to worry about. And that was the case until what? All of April, all of May, until June 1st, it went back up to 17,000. And that was then the case for the rest of the year. 12 months in a year, we've accounted for 5 months up here. So that means that there's 7/12 of the year left. You go through and you do the extension on all that, and you end up with what? You end up with 3,750. You end up with 2,083. You end up with 9,917. You sum all that, the weighted average shares is 15,750. You take that 15,750 and divide it into the 125,000. And you get this 794, the correct answer. That's a 794. Okay. Okay, good. Now, not that difficult of stuff, okay, but enough, I think you're seeing that you want to make sure and spend some time with that material so that this doesn't, become some weight around your neck on the exam date. I think it will be in good shape on these questions. Statement of cash flows, guys, 10 points, okay? I am not going to go through this because I think that most of you had exposure to this. But you should review the lecture, and of course you should do all the homework for the statement of cash flows, okay? So I am going to take the break now, and then I am going to come back and start to pick up the discussion here in chapter 8 of government. So let's take a break, and we'll come back at 7:40, and we'll start up with chapter 8, the governmental section. 10 minutes, guys. 7:40. I mean 6:40. 6:40, not 7:40. 6:40. Okay, guys, we're going to go ahead and get started back. And what I want to look at here is chapter 8, okay? And I want to look at the potential point values, okay? Now, when you look at not-for-profit, and we're going to do this before we adjourn the class for the semester, for the trimester, not tonight, but this is a 10-point area on the exam, okay? Not-for-profit, all this right here, okay, is a 10-point area on the exam. Governmental, okay, governmental, as you can see, part of it is in chapter 8. Okay, about half of it, about, section of it is in chapter 8, I don't know how much. Section of it is in chapter 9. And some of it is in chapter 10. Okay, so what is that? 2.5 chapters of material. 2.5 chapters of material. Go ahead, give me another example of an area on the exam where we have 2.5 chapters worth of material. No other part, okay? And so what happens? The reason being that this can be 20 points on your exam and maybe more. We'll say 20 to 25 points on your exam and maybe more on your exam. So if you take governmental and not-for-profit together, you're talking about 30 points on the CPA exam. Now, why am I talking in a way? Why is he irritated? I'm irritated because I see people on this Facebook group that I keep telling you not to join, that I keep mentioning, that they say, Becker went on and on about leases and didn't talk much about governmental. Where are you getting that from? The people that say that. Leases was what, half a chapter, if that? Meanwhile, what? Governmental not-for-profit is sitting there in 3 chapters worth of material. So I'm not sure how folks are getting the impression that Becker is, and I'm not here to defend Becker. You hear that there's time where I criticize some of the things that are there. I am here to make sure that you are going with clear thinking about heavy points areas on the exam, okay? And somehow coming to the conclusion that government and not-for-profit is not heavy on the exam just doesn't seem like planet Earth to me, okay? Now, I think what happens is that folks look and they see what's in the front of the book, they get behind on their study, they see stuff in the back of the book. In many cases, books put things at the back of the book that aren't considered as important, and then they draw that conclusion that somehow this is not as important. That is not the case. Do not be fooled by the placement of this material at the end of the book. It is heavy. It is possibly the heaviest area on the exam that you will see. Okay, now, all that is maybe bad news if you say, but I don't like governmental. I've never had a governmental class, whatever. We're going to get you past that. I'm going to show you that this stuff is relatively easy compared to some of the other things, leases and consolidations and some of the tougher areas that we've talked about. We're going to see that the governmental, once you get used to a couple of things that are weird, is actually a relatively easy set of points and will end up being your friend. In fact, when you pass FAR, it's probably going to be because of the governmental and the not-for-profit discussion that we're going to have, okay? So I am not going to go through the details of the different areas as to how heavy they are, as they go through the modules. Just know that these last couple chapters contain a lot of points for you, okay? All right, so let's just go ahead and take a look. And I'm going to go down to, looks like about page 43. And my dream would be to get through this part of chapter 9 tonight. Chapter 8 tonight. And then we will get into chapter 9 next time, and hopefully be able to cherry pick out some of the important parts of chapter 10 as we move forward. And then we can come back to the not-for-profit. How many classes do we have left anyway?
One more.
One.
Are you kidding?
Nope.
Hmm.
17th is the last day. Or sorry, the 18th.
Well, I may need to. What I'll probably have to do, unfortunately, guys, is add a supplemental class during the break, which you optionally can come to. I'll record it and I'll post it. What I do is I ask our e-learning folks to leave the portal open to you until the class runs again, which will be in the fall. And so it'll be open to, all summer until we have to run the class again in the fall trimester. You'll be able to come back at a later date and watch that video if you don't make it to the extra class I'm going to have to add to cover this material that I absolutely want to cover. So let's talk about that just so we can plan accordingly. When does the the summer term begin? Guys, does anyone know when the summer term begins? Is it May 9th? Whatever, May 8th?
May 9th, yes.
Okay. So what we can do you want to have the supplemental class on the 25th? What day that next week do you want to have it? On the 25th, I guess?
I can do the 25th.
Yeah, 25th works for me too.
I'm okay with 25th too.
Okay, so we'll add a class the 25th, which is going to give us some runway to get through some additional material here that I think we really should go through together. You don't have to come to that. I will post the lectures and then you'll have the lecture up there as you go through and prepare for your exam. So we'll have it April 25th, excuse me. Okay, good. Let's just plan on that. Okay, good. All right, so let's go ahead then and let's start to take a look at governmental. Okay, now what makes governmental entities different? Okay, government organizations, right? State and local governments, is they are focusing on what? The effective and efficient delivery of services. Okay, they are not business entities that are trying to earn a profit, turn a profit, increase the wealth of shareholders. There are no shareholders. They are there to provide services in an efficient, effective manner to the citizens of that city, whatever it is, right? Okay, so in trying to accomplish this, we have something called fund accounting, and it enables these entities to make sure that they are in compliance with laws and meeting funding restrictions. Okay, so compliance with laws, results in what? Legal restrictions. Okay, and fund restrictions, spending limits, will provide us with what? Financial control. Okay, so let's flashcard some of the objectives of fund accounting, which is what? It helps us to make sure that we are operating within. One is spending limits, flashcard that. One is what? Financial control. The other is compliance with laws, and the other is legal restrictions. Okay, these are the objectives, making sure that we are living within our spending limits, our compliance with laws, our spending purposes. I guess you can flashcard that as well. Okay, all of these are terms as to why we will use fund accounting in government organizations. Now, those are a bunch of words, right? But let's just go ahead and let's use an example. Let's just test my art ability. Do you know what this is?
It's a road.
Road.
Good. See how good I am at art? Okay. And let's say that what happens, a state or whatever imposes a gas tax. Okay, they impose a gas tax. They impose a tax on gasoline. And they say that that tax on gasoline will be used for what? Will be used for road maintenance, road improvement. Okay, and let's say that that says road improvement. I don't know why road improvement. And let's say that they say you can't spend more than $1 million in any 1 year on road improvement. What will we do? We would set up something called, in that particular case, probably called a special revenue fund. The revenue being the what? The gas tax. The special purpose being what? Spending money on road improvement. And the whole purpose of that fund would be to see that we spend what? We spend the money on road improvement. That's sort of our what? Legal purpose driven type restriction. And what? Within our spending limits, $1 million a year. Of course, it'd probably be more than that, but $1 million per year is all we can spend in any 1 year. Okay. This is what fund accounting does. Now, what ran through my head as I was sort of going through this example, they do that in the state of California. They put a tax on gas for road improvement. And I'm wondering that as more and more cars go to electric, what they're going to put, how they're going to get taxed for road improvement at that point in time. So look out for that. And you can probably start taxing electricity for that purpose. But anyway, never mind. Okay. I guess I'm thinking that because I recently got an electric car. So I'm like, oh, well, what are they going to do to us there? Okay. All right. But right now, yeah, state of California has a gas tax. They put that tax on the gas. And some of that money is supposed to go for road improvement. Okay. Okay, good. Now you come over, and when we talk about governmental units, okay, and talk about governmental units, and obviously it includes the federal government, state government, local governments like cities, townships, etc. Okay. Now, on the federal government, on the CPA exam, I should say, no federal government accounting on CPA exam. Okay, the standards that the federal government uses to put their financial statements together are highly specialized. They come from standards promulgated by the Federal Accounting Standards Advisory Board, the FASAB. Those are not tested on the CPA exam. It's state and local governments only. State and local governments only that are tested. And you'll see, they'll say the county of this, the city of X, and they're usually made up counties, made up cities. They don't usually make up a state. They'll just say state government, and they won't say what state because they don't want people saying, well, wait a minute, that's not how it's done in California. And so they just say the state did this, but they won't say what state. But typically, the easiest thing for them to use is fictitious names of cities and counties, okay? And that's typically what you see in CPA exam questions. So when we're talking about the standards that are used by state and local governments, it comes from the Governmental Accounting Standards Board, GASB, okay? GASB sets the standards. They are considered category A. They're considered the most authoritative. GASB stands for the Government Accounting Standards Board, abbreviated as GASB. What you have is you have the Financial Accounting Foundation, okay? And the Financial Accounting Foundation is sort of the company that, the entity, not a company, but the entity, not-for-profit entity that holds the FASB and the GASB. GASB is state and local government. FASB is for-profit, but they also promulgate the standards for not-for-profit. Okay, so when you talk about private sector entities, that's the FASB. When you talk about the state and local public sector entities, remember I said the federal government is completely different, then we're talking about the GASB. They are both in the same building in Connecticut, but they have obviously two very different purposes. Okay, now you come over and you take a look at this little chart here, okay? And they tell us that the GASB, and it's GASB 34, talks about the general external financial reporting purposes for basic financial statements that we'll be talking about and learning about in this set of our study, and required supplemental information. There's additional information that go beyond the balance sheet, et cetera, that state and local governments have to provide. And the CPA exam does ask you a little bit about that. The CPA exam also will ask you a little bit about the comprehensive annual financial reporting. Sometimes they're just calling those the annual report. I think in the state of California, they left out the term comprehensive and they just call it the annual report, the annual financial report. Some governments still use the word comprehensive annual financial reporting, okay? But the standards for that are issued by the GFOA, the Government Finance Officers Association. So that's not really the GASB, but if you look, and the CPA exam, you know, doesn't get into a lot of mention of the Government Finance Officers Association's Bible, okay, but this is this thing. Okay, and so that's where a lot of the information comes from, okay, that is talked about in the Comprehensive Annual Financial Report, but it is not very extensive on the exam, okay? The main area for the exam that you're going to be seeing is going to be right in here. And then also, what are some of the budgetary requirements, okay? And so you're going to see some of that, okay? Some of this other stuff really starts to get into stuff that the GFOA would be talking about. Again, that stuff is very light. Your big point values are going to be right here. Okay? Okay, good. But we'll cover all these things as we go through. Now you come over and you start to look at some of these things, which get a little too much in my opinion. And then they draw this picture that I don't know about you, but this picture creeps me out. I'm afraid of rodents, so I'm not going to look at that because I don't think that that is stuff that is particularly helpful to you, okay? What I want to look at is when they talk about, on this next page, external reporting, okay? Now, everything on the CPA exam dealing with government is external reporting, okay? So why they're calling out this as external reporting, but they say that GASB establishes minimum reporting requirements to be in compliance with GAAP, and they talk about both fund-based and government-wide financial statement presentation. That's, since we're talking about the basic financial statements that you saw in that other chart as being so heavy, let's just try to give ourselves a graphic as to what we think this might look like, okay? So what happens? When you look at a government's financial statements, you'll see fund financial statements and you'll see government-wide financial statements. Okay. Now, when you see the fund financial statements, you will see governmental funds. You will see proprietary funds. I'm not going to write the word funds each time. Governmental funds, proprietary funds, and you will see something called fiduciary funds. All of these are fund categories. So when you look, we have what? 1, 2, 3 categories that get reported. Okay. Now, it turns out that there are 5 governmental funds, and I'm going to define these out for you here, what the names of these are in a minute. Okay. That's not a graveyard. Those are the columns for the different funds at the governmental category. There are 5 of those. When we look at our proprietary fund category, again, I'm not putting the names because we'll see those in a little while. There are 2 of those. And then when we look at the fiduciary funds, there are 4 of those. So there are a total of what? 5 plus 2 plus 4. There are a total of 11 funds. Okay. 11 funds that fall in 11 fund types. Okay, maybe we should say 11 fund types. Okay, because there could be several different of the types of proprietary funds. So there are 11 fund types and 3 fund categories. Okay, now, when we look at this, what the government will do is they will report all that fund level activity, but then they will go ahead and consolidate that information at the government-wide level. So you'll see something called government activities. You'll see something called business activities. Okay, and what they do is they roll up information from these disaggregated fund information and consolidate it, sometimes under governmental activities, sometimes under business type activities, and sometimes they don't report fund level activity at the government-wide level at all. But we'll get into more of that later. But what I want you to understand that there are 2 levels, and we have what? We have the fund level, we report all that, and then we have what? And then we have the government-wide level, which is a consolidation of the funds. Just like in corporate accounting, you could have what? You could have company A, company B, as we learned in chapter, I always forget what chapter was it, 3 or 4? Chapter 4. Just like we learned in chapter 4, and company A and company B are under common ownership, so they get consolidated and do a set of consolidated statements. The government's going to do the same thing. Now, of those, 20 points or so that I talked about, probably 15 points are right here. Okay, probably 5 to 10 points, okay, are going to be up here on the government-wide statements, okay, because included in there is some information about that supplementary information, the comprehensive annual financial report that, constitute maybe the amounts beyond the 5. But you can see where we're getting that 20, 25 points that I talked about earlier. Now, for the most part, we will be covering in F8 and F9. This stuff comes in F10, okay? And I'll be selecting out certain parts of this that I want to go over with you, and that's probably when we're getting into that extra class, we'll start talking about that, okay? Question? Okay, good. So with all that is just sort of an overview. Let's go ahead and let's look at this first question dealing with governmental. Okay, I'm going to go ahead and end the poll. It's about a minute, and I don't think it should take you much longer to answer this question. So let's just go ahead and look at this one. And just about everyone got it right. Okay, it is A. And that when we look, we established the fund accounting to see that and I had you flashcard some of these terms, that we're establishing financial control. Yes, spending within, sort of spending limits. And compliance, which compliance is the same as saying legal restrictions. We're going to spend what, $1 million financial control on what? On road improvement, a legal restriction. Okay. Let me do something real quick. It's that time of year where I'm torn between having blinding light and shadowy darkness here, but because the lights can't take effect and the sun is so bright, but I think this is a little better, so I'm not looking like I'm standing in the dark here. Okay. All right, good. So let's go ahead then and let's take a look at our next module, in which we're going to talk about fund structure. Now, as we know, we have what? As I previously mentioned, we have 3 categories of funds. And then we have what? We have 11 fund types. And I sort of drew that little silly picture of that earlier. Okay. So when we look at our categories, governmental funds, okay, we're going to need to know what type of accounting and measurement focus are used by these funds. Okay, so for our governmental funds, we use something called modified accrual accounting, and we use current financial resources measurement focus. Okay, now what does that mean? Now you look, and let's say I buy a piece of fixed property. Let's say a steamroller. I'm a government. I buy a steamroller and I pay cash for it. I'm going to use that steamroller to flatten road beds when I'm making roads. Okay, the road improvement thing. Okay, what journal entry would you make using your full accrual accounting if you're accounting for this? You buy a piece of equipment for cash.
Equipment.
Really? Huh?
Debit equipment, credit cash.
Good. You're going to debit equipment. Say we pay $1,000 for it. I don't know. Good. And you would credit cash. This is the accounting you've been doing since you were 2 years old, right? Okay. But that's under full accrual. But let's say that this equipment was purchased by one of the governmental funds, say the special revenue fund that's keeping track of road improvement. Well, if that's the case, under modified accrual, they tell us that you would debit expenditure for $1,000 and credit the cash for $1,000. That's $1,000. Debit the cash. Debit the expenditure, credit the cash for $1,000. Well, you look at that and you're like, well, that's weird. Why are they doing that? Well, remember that with our governmental funds, we are interested in seeing that money was spent within the legal restrictions, within the spending limits. We've achieved our accounting objective here by being able to show that the special revenue fund spent money on a piece of equipment that's used for road improvement. So we don't need to worry about maintaining capital asset and depreciating it, all things that are consistent with what? With profit motive, which is not relevant to government. We're just looking at the efficient and effective delivery of services here, okay? So On the CPA exam, guys, one of the main things that they're going to try to, take those 15, 20 points away from you is by confusing you that you should be using full accrual accounting when in fact you should use what? Modified accrual. And this one thing I'm telling you right now, probably going to be good for maybe 3, 4 questions right there on the CPA exam. Okay. The problem that folks have, they're feeling that they're not doing well with governmental, is they're not extracting some of the key things that are going to be asked, getting comfortable with those. And once you're comfortable with that, that's pretty easy. Okay. Now, one of the other things that they like to do on the exam is, do you know what fund types fit into the fund categories? What are the names of those funds? Okay. And we know there are 5 of them. We have the general fund. We have the special revenue fund. We have the debt service fund. We have the capital project fund. And we have the permanent fund. Okay. That is pronounced, not C there, but P. That is pronounced, and not, come on, John, not D, but S. That is pronounced grasp. Grasp. There's no A in there. That is pronounced grasp. That is useful for helping you remember the 5 governmental funds: general fund, special revenue fund, debt service fund, capital project fund, permanent fund. And they will literally ask you question 2, 3 on the CPA exam that tests just that very simple knowledge. Okay. Now you come over and the fact that they use what? So they'll say, which of the following fund uses modified accrual basis of accounting current financial resources? They'll give you one of these as the correct answer. And of course, the other 4 will potentially be a fund that appears in another category that we're going to look at in a minute, or maybe they'll just make some silly name of a fund up that is not relevant. Okay. Very simple stuff, guys. Okay. Now, when we look at the governmental funds, they prepare 2 financial statements. Okay. Flashcard the names of the 2 financial statements. One is the balance sheet, which is like the balance sheet. Okay. The other is the statement of revenues, expenditures, and changes in finance and changes in fund balance. This one is like LIKE, the income statement. Okay. Now let's look at this balance sheet first. Okay. And notice, guys, right out of the gate, we only have current items, only current assets and current liabilities. There are no long-term assets. There are no long-term liabilities. Well, that shouldn't be that much of a shock, since when we purchased a thing like equipment, we did what? We reported it on the as an expenditure. It's going to end up going on the income statement, not the balance sheet. So we only have current assets, current liabilities. Okay. Now we're going to get into this more later, but deferred inflow are sort of, deferred outflow here are like prepaid items, but not quite. They're sort of between what? Between a prepaid item, which is still considered a current asset under governmental accounting, and they're not quite up to the level of a current asset. So they call them deferred outflows. And we'll talk more about those later. Deferred inflow, the key thing is to know that they are what? They are listed with the current assets. Okay. And then deferred outflow are like unearned revenue, but not quite. And so they report them as a deferred inflow, and they sit there next to the liabilities. Okay. Now, when you look at the way this balance sheet is required, okay, this is the required format. This is the required format for the balance sheet. Let me ask you this. Have you ever looked at a balance sheet and seen it written in a manner where they give you the assets, they list whatever those are, and then they show you the total assets, and then they show you the liabilities, and they give you the total liabilities. And then they give you the stockholders' equity. They give you the total stockholders' equity. And then they have a bottom line where they say total liabilities plus stockholders' equity. Okay, so that if you had assets of 100 and you had liabilities of what, 60, and stockholders' equity of 40, then the balance sheet would balance so that the total liabilities and stockholders' equity would be equal to total assets. Has anyone ever seen that before?
Yes.
Okay, that is a common way that you see balance sheet displayed. Pick up Apple's financial reports. All companies do that, right? Okay, so if you look at this required format for the balance sheet for a governmental fund, that's what they're doing. They're showing you the current assets. Okay, we put deferred outflows next to the current assets, and we'll tell you more about deferred outflows later. The current liabilities, they put the deferred inflows next to the liabilities, and we'll tell you more about deferred inflows later. Fund balance, okay, fund balance is LIKE, like retained earnings. Now, sometimes folks will say, well, isn't it actually like stockholders' equity? No, because governments don't issue stock. Okay, they issue bonds, they don't, which are liabilities, they don't issue stock. You can't go, hey, give me, 300 shares of, I want to own 300 shares of California stock. No, bonds, yeah, not stock. Okay, so since state and local governments and the federal government don't issue stock, okay, then the fund balance is really going to be what? Like retained earnings, but they take the liabilities, add it together with the fund balance, and then that's going to be equal to the what? To the total of the assets, total current liabilities, deferred inflows of resources, and fund balance. They'll give you that total. So if this was 100 and this was 60 and this was 40, that would add up to 100, right? Question, guys? That is the required format. Flashcard that. Okay, now for the income statement, I want you to flashcard this format. It's revenues minus expenditures. Those expenditures are including amounts that they spent for purchase of equipment. And then we have these other financing sources, other financing uses. Okay, other financing sources are like LIKE, non-operating revenue, and other financing uses are like non-operating expenses. Okay, and net change in fund balance is like net income. Okay, so let me ask you a couple of questions then. If fund balance is what? Like retained earnings, and change in fund balance is like net income, then would revenues increase your net income or decrease your net income? Question. That's the easiest question I'm going to ask you all night. Would revenues increase your net income or decrease it?
Increase.
Increase, good. So since what? Since my fund balance is like my net income, then revenue should do what to fund balance?
Decrease.
Okay, let's try this again.
Oh, sorry. Increase. I misheard you.
Yeah, sorry, it's good. It's going to increase my change in fund balance, which is like my net income. And since net income increased retained earnings, revenues increase fund balance, right, Kylie? Which is what I think you meant to say, right?
Correct.
Okay, expenditures, would they increase or decrease my net income?
Decrease.
Decrease it, good. And since what? Since my change in fund balance is like my net income, expenditures must do what? Must decrease my my change in fund balance, make it less, and therefore do what? Decrease my fund balance, right?
Correct.
Okay, good. Other financing sources are like non-operating revenue. Would non-operating revenue increase or decrease your retained earnings?
Do you net out that? So the effect would be if it's more than it increase.
Non-operating revenue increase or decrease my net income? There's a right and wrong answer.
Increase.
Roy?
It could increase or decrease.
How? Explain to me how non-operating revenue would decrease my net.
I was actually, I mishear you. I thought the other operating revenue and uses. So if it's just other financing sources, then of course it will increase.
Okay, we're all over the place here. Let's just stay on the range, cowboy. Would non-operating revenue increase or decrease my net income?
Increase.
Good. And since other financing sources is like non-operating revenue, then it must do what to my fund balance?
Increase.
Good, good. I know where you were going, but I just want to keep this. Please don't take the information faster. Computer, very smart computer, don't kill me by taking the information from my brain faster than I can give it. Okay, good. Would Roy, would non-operating expenses increase or decrease net income?
Decrease.
Decrease it. Good. So since my what? Since my other financing uses are like non-operating expenses, they must do what to fund balance? Since other financing uses are like non-operating expenses, what do they do to fund balance?
Decrease.
Decrease it. Good. Good. Everybody with me? Okay, because the exam is going to expect you to understand how these different things affect the change in fund balance. If the change in fund balance is like net income, my change in fund balance goes down, my fund balance goes down. My change in fund balance, my net income goes up, my what? My fund balance goes up. Okay? Okay, good. Now, you come over, and again, guys, this stuff is not hard. It's just you got to get used, you got to digest it a little bit, okay? You see what I'm talking about? And if somebody just waits a day before their exam to flip through the governmental, they're in for a world of hurt, okay? So you got to spend the time with this stuff, okay? All right, good. Now we have how many categories of funds? 3. We dealt with the governmental. Here's our second category, which is the proprietary funds. And we have what? We have 2 fund types. We have, and you can see down here, the 2 fund types are the internal service fund, which is S, and we're building a mnemonic here. And we have the enterprise fund, which is E. Okay, internal service fund, enterprise fund, and they use full accrual economic resources measurement focus, guys. And when we get to the specific accounting for these proprietary funds, you're going to be like, oh boy, this is easy because I know very well full accrual accounting, and there's nothing that complex about the way they account for transactions in these funds. Okay. Now, when we deal with the internal service fund, internal service funds are set up to account for goods and services provided by designated departments on a cost reimbursement fee basis to other departments and agencies within a single governmental unit. Okay. And they talk about a motor pool. Now, what happens? Do cities own vehicles?
Yeah.
Yes.
Yeah. Let's hope, you don't have one behind you when you're driving home on a Saturday night, right? Which is a police car, is a city vehicle. What? Fire trucks are city-owned vehicles, and these are emergency type vehicles, aren't they? So what happens? They want to maintain those at very high specifications. So what do? They set up a mechanic shop, and they have all of the emergency city-owned vehicles and whatnot brought to that one shop, okay? And so what happens? The police cars are worked there, the fire trucks are worked there. Now, let's say I was having a little car trouble. Could I drive in there and say, excuse me, can you please help me with my car? They're going to say, hey, the private citizens motor outfit is down the hall. Take that back to your dealer. Down the street, take that back to your dealer. We're not dealing. We only deal with what? City-owned vehicles here. Okay, so they call that an internal service fund. We still use full accrual accounting because what happens? Well, they're going to need equipment. They're like a business, but the customers are what? Inside of the government as opposed to outside the government. Okay, and they are not there to gouge the other departments. They are simply there to cover their costs. So they're really going to charge those other departments for the service they provide, and it's on a cost reimbursement basis. They don't sit there and say, well, we need to build a profit for this, so here. No, they're going to just try to cover their costs. Okay, that's an internal service fund. The enterprise fund, okay, is set up to account for the acquisition and operation of government facilities that are intended to be primarily self-supported by user charges, water utility, for example. Okay, so what happens here? Let's say you're getting ready to go out on a Friday night and you're washing your hair, gonna look good, and all of a sudden they turn the water out on you. You got soap in your eyes. You say, help, help. What does the city tell you? They turn the water off on you. What do they tell you?
You didn't pay.
Before they turn it back on, huh?
Something when you didn't pay.
Pay your bill?
Yeah, they're going to say, hey, pay your bill. Okay. And they're telling you to pay your bill because what? Because they need that money to run the water utility. They need that money to run the water utility. So what do? They sit there and they operate that in an enterprise fund because more than 50% of the cost are being recovered by user charges, those outside the government. Now, that doesn't mean that the government itself doesn't use some of the water, because they do to, water city parks and that sort of thing. But most of the money is coming from what? Those outside of the government. Okay. Now, that's sort of a big picture as to what what constitutes enterprise fund. This is a little granular, in my opinion, but you might see one or two questions on the exam in which they say, what are the criteria in order for something to be accounted for as a enterprise fund? Okay. And so notice that the law requires the collection of fees to cover the cost. Okay, so let's underscore an important word there, fees. Principal policies are established to produce what? Fees to cover cost. And then the activity of the fund is financed by debt secured by a pledge of what? Fees. Okay, so what's the key word there? Fees. You should flashcard the detail here, guys, but if they're sitting there and they're telling you, hey, look, this thing is having its debt covered by fees, or law requires the collection of fees, or a pricing policy established so that they can recover fees, then that means that it is a what? Enterprise fund. Okay. Okay, good. So let's look. Most important thing, the category, proprietary fund. What type of accounting do they use? Full accrual, economic resources measurement focus. What are the two funds? The internal service fund and the what? Enterprise fund. Key, easy takeaways, yielding points. Okay, now let's look at the structure of their financial reports. Okay, let's flashcard this. And you have the statement of net position. Statement of net position is like the balance sheet. We have all assets, all liabilities. It's not current financial resources, it's economic resources measurement focus. So it's both what? Current and long-term assets and liabilities. Notice here, like we saw for the governmental fund balance sheet, we line up the deferred outflows with the assets, the deferred inflows with the liabilities. We subtract the assets from the liabilities, and we end up with net position. So is it true that if we had assets of 100 and liabilities of 40, that our stockholders' equity would be 60? Right? So what they're telling you, and this is the suggested, not suggested, maybe recommended format. For our proprietary funds, the internal service fund and the enterprise fund, they will be showing it this way, where they'll show all of their assets plus their deferred inflows. I'm just saying, say those add up to 100. And then all our liabilities plus our deferred inflows, say those add up to 40. Then that difference would be what? 60. And that's the way they would show it. They wouldn't roll up the liabilities and the net position again to show that those add up to 100, like we saw in the required format for the governmental funds, as many private sector entities do. Net position is like LIKE, retained earnings. Again, these entities, even though they're more like commercial entities, do not issue stock. They may issue bonds, but they don't issue stock. And so the equity portion, if you will only be that net position, and that just constitutes the fund balance. Okay. I was on a assignment, the GAO, they asked me to look to see if I had seen any indicators of state and local governments inappropriately charging federal programs for reimbursement on expenditures. And one of the things that's not an allowable cost is profit. So what I did was I looked through a sample of state and local governments' financial reports, and I found those that were reporting a large net position. And the point there was, if you're reporting a large net position, then you're building profit, since net position is like retained earnings, into charges that are potentially hitting government programs. And the recommendation there was that various cognizant agencies that are over different types of programs look to see if profit was being charged against federal programs, which was not an allowable cost, because that net position is what is like the retained earnings. I don't think that they ever implemented my recommendation, but I still made the recommendation. There's recommending, and then there's, people ignoring the recommendation. Okay. All right, good. Now we have what? We have statement of revenues, expenses, and changes in fund net position, which is like LIKE, the income statement. Okay. And you have what? You have operating revenue, operating expenses, you have non-operating revenue and expenses, and you have change in net position. Change in net position is LIKE, like net income. Does that format of the income statement sound familiar to you?
Yes.
F1 is back. Operating revenue, operating expenses, non-operating revenue and expenses. We don't have discontinued operations here, but we have something that is very, very similar to what we saw in F1, right? Okay, good. Let's look at our fiduciary funds now, okay? And this is our third category. All right, category, I respell category, I can't spell as you well know, which is what? Our governmental funds, our proprietary funds, and now our fiduciary funds are the three categories. We have fund types, and as we mentioned before, our fund types, there are 4 of them, okay? And the mnemonic here is going to be, for the custodial funds, that's I. For the investment trust fund, custodial funds is C, investment trust fund is I. Private purpose trust fund is the P. We have another P here, and then for these, they go OE. I just recommend that you remember KIP, okay, CIPP. CIPP for KIP. That'll help you remember the different custodial funds. I mean, the different fiduciary funds, excuse me, fund types, okay? Now, when we're dealing with the fiduciary funds, we use full accrual, economic resources. So think about a potential CPA exam question that's going to be very easy for you. Which of the following funds will use what? Will use modified accrual accounting? The investment trust fund? No, that uses full accrual. The private purpose trust fund? No, that uses full accrual. The enterprise fund? No, that uses full accrual. What would have to be the right answer in the fourth installment of choices, which would be what? Which would be, and it'd have to be one of the governmental funds, say the custodial, say the capital project fund would have to be the correct answer there. Okay, easy points on the exam just from remembering these different categories and fund types, the type of accounting they use. Now, when we look at the financial statements, okay, and for our, by the way, for our proprietary funds, there are 3 financial statements. Okay, 3 financial statements. Okay, the statement of net position, which I said is like the balance sheet, the statement of revenues, expenditures, and changes in fund net position, which I said is like the income statement. So you're saying, well, what's the third one? The third one would be the statement of cash flows. I'll write it up here. Okay, so only the proprietary funds prepare a statement of cash flows. Everyone else, it's a balance sheet for the governmental funds and the proprietary, for the governmental funds and the fiduciary funds, it's just the balance sheet and the income statement. For the proprietary funds, although they didn't show it here, it's the balance sheet, the income statement, the statement of cash flows. Okay, now for our fiduciary funds, then, as I just stated, there are 2 financial statements. There is the statement of fiduciary net position, which is like the balance sheet. Notice they say, hey, assets minus liabilities equals net position. Net position is like retained earnings. This is the required format. Okay, so for the governmental funds, the required format was what? Showing the roll up of the liabilities and the fund balance matching the total of the assets, right? Whereas for our proprietary funds and our fiduciary funds, it's that difference equation, the difference between the assets and liabilities equaling the fund balance. For the proprietary funds, they said it's recommended that you do that. But for the fiduciary funds, they say it is required that you show this way. And then for the statement of changes in fund net position, which is like the income statement, additions are like revenue. Deductions are like expenses. And then the difference between those is going to be what? Like net income. Okay. Okay, good. So flashcard, the format and whether it's required or option or recommended for all of the funds, as I have indicated as we've gone through and talked about the structure of their financial reports. Okay, good. Now, what I want to do is have you go to, I want you to put C page 55 right here. Because notice we went through a lot of that discussion about the categories of funds and whatnot, and I didn't ask you for a flashcard. And the reason was that I wanted you to go ahead and I wanted you to hold off until here to make the flashcard. And you probably have this in your Becker cards, but if not, you can go ahead and make this flashcard here. You can even copy this page. What I like about this particular, presentation is it tells you the category of funds. This is the governmental funds. It tells you that they use what? That they use the modified accrual basis of accounting, current financial resources measurement focus. They give you the mnemonic, and then of course they give you the details of the names of the funds. So that's a very efficient flashcard for you. Got a lot of useful information, going to give you 4 or 5 points right there on the exam. Okay, and then you go and they say, well, which funds are going to use the economic resources measurement focus? And it's everybody else. Okay, it's all the other funds, but again, they give you the mnemonic. And, you know, it is my advice that you just remember KIP. To have to remember PO part of KIP to me seems like a little too much, but it's what? GRAS CKIP. GRAS CKIP is the way you remember the funds, and then you remember the categories by having this flashcard. Are what? Our proprietary funds, are the internal service fund and the enterprise fund, our custodial, our fiduciary funds, our custodial fund, investment trust fund, private purpose trust fund, and the pension and other employee benefit funds that really aren't asked about that much. So those are 2 very good flashcards that summarize much of that key stuff that was on those previous pages. Okay. Okay, good. So make these into flashcards or look through your Becker flashcards to make sure you have something like this. And then with the time that we have left, I want to go ahead and try to get us through some of this other stuff that I went past, okay? Which is what happens with this current financial resources measurement focus. And remember, with our current financial resources measurement focus, when we purchase long-term items like an asset, like equipment, we're going to debit expenditure. So that means that there are what? No fixed assets, no long-term liabilities, current items only. Okay, so you can go ahead and you can flashcard that. You want to flashcard that? Okay, you can. You might have a flashcard already like that. When we're talking about the rest of the funds, the proprietary funds and the fiduciary funds, as well as the government-wide statements, by the way, guys, we haven't said a lot about those, but remember they are up there. We're down here right now talking about those 11 fund types, but remember they consolidate up into the government-wide. And so for them, they also use what? Full accrual economic resources measurement focus. And so yes, do report fixed assets, do report non-current liabilities, okay? When we talk about basis of accounting, for our governmental funds, we used what? For our GRAS funds, our governmental funds, we used modified accrual basis, and the revenue is recognized when measurable and available, okay? Measurable means it is quantifiable in monetary terms, meaning we know the amount. We pretty much know or can estimate pretty carefully, pretty closely what that amount is going to be. So it has to be measurable, okay? And then available, which is where they focus more, means that it's collectible within the current period or soon enough thereafter to be used to pay liabilities of the current period, generally within 60 days after year end, okay? Now, 60 days is probably the most common, okay? But it could be 30 days, could be 60, could be, which is the most common, why they mentioned that there, could be 90 days. I've seen some governments where they'll say, hey, we still consider it available at 180 days, okay? So you have to look at CPA exam question, and if they'll tell you they use 60 days, then something's still going to be considered what? Available if it's collectible within 60 days, and that's the most common. Sometimes they don't mention the 60 days, which is annoying, and they don't mention the amount of days, but they'll say something like, the rest of the amount will be collected during the year. They'll say something like that. Well, when it's that vague, then you're going to say, okay, well, the criteria must be this 60 days, and you'll just use the first 2 months. And if they kind of lump everything else together in another category, the rest of the year, then that's not going to be considered available. So if you had a question that said the city of Hayward had taxes and it collected during the year 100, it will collect, and let's say it has a 12/31 year end, 12/31, say 23 is the year end. Say they're preparing calendar year financial statements, which by the way, most governments are on fiscal year, but let's not worry about that right now. 12/31/23 year end, they collected 100 during 2023. In January of 24, they'll collect 50. In February of 24, they'll collect 30. And in March, let's make it a little clearer. In April of 24, they'll collect 70 using the 60-day criteria. Okay, let's say the question tells you it's 60 days. What is the revenue for 2023? Okay, so they mailed out tax bills in sometime during 2023. They collected 100. They collect 50 in January, they collect 30 in February, and they collect 70 in April using the measurable and available criteria with 60 days as called out specifically in the question. Let's say, what is the revenue that they can recognize for 2023? How about the 100?
Yes.
Yeah, because they collected it. How about the 50?
Yeah.
Yeah, because it's getting in there within 60 days, right? How about the 30?
Yes.
Even in a leap year, it would make it, right? How about the April money?
No.
No, we wouldn't include that because that's falling outside of the problem called out, the 60 days, okay? And as I said, sometimes they won't call out a 60-day criteria. So the answer to this question would be what, 180? Sometimes they won't call out the 60 days specifically, but they'll say the rest of the money is going to be collected during 2024. Well, now we're potentially getting out all the way into December 2024, and that wouldn't meet the available, and so you would ignore the 70 in that case as well. Okay, question. Okay, now expenditures, they tell us, are generally recorded when the related fund liability is incurred, with some exceptions, and the most notable is what? Interest. We do not accrue interest in between interest payment dates. So what does that mean? City of Hayward issues bonds on January 1st. Interest rate is 6%. $100,000 worth of bonds, $1 million worth of bonds, whatever. Interest rate is 6%. They issue those on January 1st. The interest payments will be due January 1st each year thereafter. At December 31st, year one, how much interest expense should Hayward report? And you're going to want to be a good accrual accountant, say $1 million times 6%. John, that's got to be, what does that come out to? 60,000, whatever number that comes out to. That's got to be the number, right? The correct answer there would be what? 0, because you do not accrue interest in between interest payment dates. You would have to wait and record that interest expense in what? In 2024, if that's when you paid it. Okay, so flashcard, that very important exception to how we treat expenditures, even though they're liable at that point because they borrowed that money for the full year. And at December 31st under accrual accounting, yeah, you would record what? You would record the liability, interest payable, and take the interest expense, debit the interest expense. Under governmental, we don't do that. We wait until we enter into the year when it's going to be paid. And we'll practice more with that. Okay. Okay, good. And then if we're dealing with full accrual accounting, revenue is recognized when earned. expenses are recognized when incurred. You've known that for a long, long time. Okay. Okay, good. That gets us through that first module. So before we adjourn for the evening, let's look at a couple of multiple choice questions. Okay, looks like everybody has tried this one. Yeah. Okay, so let's go ahead and let's take a look. No sense to delay if everyone's had a chance. And most of us got it right, 82%. And you'll look and they're saying which one uses economic resources full accrual basis of accounting. I look at that question and they're saying, hey, only one of them will use this type of accounting. So I'm saying they must be listing governmental funds along with one of the other fund types that come in the categories. That's gotta be because what? Because the governmental funds use modified accrual current financial resources. And sure enough, I look and they have what? The wrong answers. They have the general fund, the what? Permanent fund is a governmental fund. The capital project fund is a governmental fund. Only the internal service fund is another category, which is what? The proprietary fund category, and everybody else uses what? Full accrual economic resources. Please, God, may you get 52 questions like this on your exam. Easy stuff that people cry about later. And I'm looking at those comments, and I hate to keep mentioning the thing I hate here, because that's my friend the other day said, why do you always have to say negative things when we go to the baseball game about what the A's are doing? And I'm like, how long have you known me? This is my high school friend. My whole life I've looked into things like that. That's why I was a pretty good auditor. Okay, so sorry for the negative vibe here, but what? You know, I'm looking at that Facebook thing. It's like you just didn't spend a little more time with the governmental and you wouldn't be saying that. Okay. All right, good. Let's go ahead. Let me get off that soapbox and go ahead and take a look at this next one. Okay, guys, I'm going to go ahead and end the poll. Most of us, and one more answer coming for one of the wrong choices, but we were up over 80% before that last one came in. But just taking a look, okay, 73% got it right. And I'm not sure why this is 100%, so I'm going to have to do a little talking here. How many funds use modified accrual current financial resources? How many fund types? How many fund types use modified accrual current financial resources measurement focus?
One.
One. The governmental funds are the only one. So if I look at this question, even if I couldn't remember which fund it was that used the selected measurement focus and accounting that's being asked, modified accrual current financial resources current financial resources measurement focus, there better be 2 no's in the right answer because only one uses it. So I look, A is wrong because it doesn't have 2 no's. B is wrong because it doesn't have 2 no's. D is wrong because it has no no's. C is correct because what? Because only the governmental funds use modified accrual current financial resources measurement focus. Guys, I don't know that you're going to get anything easier than that on the exam. Okay. All right. So you're going to have some practice with that as you go through this module 6 of chapter. We're in chapter 8 now. Skip to module 6. We'll pick up module 7 when we come back next week. Okay. All right, guys. Have a good rest of the evening. I will see you next week.
Thank you so much. Have a good night.
Good night.
Thank you.
All
Bye.
right, Professor.
Good night.